So if you're buying trading courses looking for that one perfect strategy, then I need to tell you something that's going to save you years of frustration and thousands of dollars. And it's that strategy does not exist. And I know this because I spent years searching for it before I finally figured out what actually works. I'm Austin, and I now run a $70 million algorithmic trading platform, but I learned these lessons the hard way. I'm going to share a bunch of critical lessons that changed everything for me, from losing money on course after course to building strategies that consistently beat the market. And one of these lessons will show you why win rate is one of the biggest lies that keeps traders broke. Another one of these lessons reveals the one mistake that costs traders more money than anything else. And by the end of this video, you'll know exactly what separates profitable, systematic traders from everyone else still chasing magic bullets. So let's get into it. So the first thing that I learned is that no single strategy works all the time. Now, unfortunately, I learned this the hard way by spending a bunch of money on online courses, looking for something that was just going to perform in every single market environment, give me the consistency that I always dreamt of, and never incur large drawdowns. Well, the reality is that doesn't exist. Okay, so the one thing that you can have that's the closest thing to that is multiple setups for different market environments. Now, when you have different setups that thrive in different environments, it allows you to build a playbook to be able to capitalize on different market conditions, which then gives you that consistency and that stability and the ability to perform in different types of markets. Now, what I mean by this specifically is having maybe a strategy that thrives in upward trending markets. Maybe then you also have a strategy that thrives in down markets. And then you also have a strategy that's maybe a good mean reversion strategy. So you have a trending strategy for up markets, a trending strategy for down markets, and then a mean reversion strategy in between. Maybe that one's long short. You combine those three together, and now you are able to take advantage of three different types of environments, and then also hedge the performance from those strategies against each other. Now, that is going to be the easiest way to find something that is remotely close to a magic bullet, because a singular magic bullet strategy simply does not exist. Okay, so I'll tell you, I've spent tons of money on courses. I've spent tons and tons of time developing trading strategies, and you really just don't get a magic bullet strategy. However, you can get a bunch of really good strategies that thrive under certain conditions and then combine them with other types of strategies, and you can get something that is really, really nice. So I would say stop looking for the one holy grail and build your own holy grail from a diversified set of different strategies in your playbook. Ideally, those are going to be uncorrelated strategies. So what that means is they're not moving together. You don't want to have, three different setups that are all looking for the same type of move, because then you're basically just amplifying your risk, and you don't want that. You want to be able to take advantage of different market conditions and have different strategies that perform at different times. And the reason for that is when one strategy suffers, you want another one to balance it out and ideally put some profit on top. Okay, so make sure the correlation between the strategies is low. And we'll talk about another thing that I learned shortly after this point that is going to make that analysis very, very easy. Okay, so that would be shifting my focus to systematic rule-based trading. Now, this is something I learned that absolutely changed the entire trajectory of my career. I wish I learned it earlier. However, I'm just glad that I learned it at all. So clear if-then rules in your trading strategy is going to beat discretionary trading for consistency and validation every single time. Now, that's not to say there's not some great discretionary traders out there. There certainly is. However, it is much, much easier to validate your idea and your strategy on a if-then systematic based rule set compared to just going in off emotion, right? If you have, your hunch and you're following your gut based on, whatever it might be in the market, you're going to need a very, very sufficient sample size to actually judge the efficacy of that system. Now, what I mean by that is you're going to need to place a lot of trades in the live market to tell you if your idea is right or not. And if you don't have any if-then rules, the only way you can do that is by actually going out there and placing those trades and then analyzing the data. And by then, you might have already incurred a bunch of losses. And not only that, you just lost all that time where you could have capitalized on really good opportunity. So the way to combat that is by having if-then rules for your setups, for your strategies, whatever you want to call them, and then being able to backtest it against very, very large sets of data. Now, there are tons of really, really great softwares out there now that will allow you to backtest over very, very large data windows very, very quickly. That's going to be the main thing, is you want to do it on really large data sets. So whenever you backtest a strategy, you don't just want to sit there and go back on your chart and, find a setup that meets your rules and log it in a spreadsheet and, just do that for hours and hours and hours and days until you have, 200 samples. Because the reality is you could simply just take your rules, feed it to an LLM nowadays, have it write you some code that works in NinjaTrader or TradeStation, and then throw it in there, make sure it's executing, how you would actually do so yourself, and then throw 5-10 years of data at it and see how it holds up. That is going to be a much, much more efficient way. And nowadays it's so easy just to give some rules, to an LLM and tell it, what type of language to write in, and then be able to test the idea. So I certainly would go that route rather than just manually backtesting through spreadsheets and then gathering the data that way. I used to do it the manual way, and it was really inefficient, took a long time. It was a great experience, but I'm definitely grateful for the programs that make that a lot easier now. And now just with AI, I mean, there's really no reason why you should go another route. Now, if you're going to want to go ahead and trade that strategy live, I would definitely recommend having a human programmer go over that code, make sure there's nothing missing from it that you would actually want. And obviously you want to do some pretty significant robustness testing to make sure that it's going to be all good. But, I digress. That's not really the point. The whole idea is that, taking a systematic if-then rule-based system, exposing it to large data sets, and validating your idea before you even risk a nickel. Okay, so that is a huge, huge benefit to systematic trading that you can't really do with discretionary trading, right? Because you can't program your feelings and then test them on, 5 years of data, right? But you can do that with if-then based rules. So that's the biggest thing is, if you went out there and you found your multiple strategies or your setups or whatever it is in your playbook, now really sit down and quantify that into if-then based rules, see if you can turn it into code, and then see what it looks like on a large data set. Now, the large data set is really important. 1 year of data is not enough. 2 years of data isn't enough. I would definitely go 5+ years of data to actually validate, what it is you're looking for. And then obviously make sure if you're tweaking any parameters that you're not tweaking those parameters on the entire data set, because now you're just manipulating that data and doing what's called curve fitting, which is just going to give you inaccurate results when you actually go to trade live in the future. Okay. Now, if you're wondering what programs would be good for that, I would recommend something like NinjaTrader, TradeStation, or MultiCharts. TradingView does allow you to build strategies. However, TradingView is good for charting, but it is not great for automation. So once you are actually ready to push off the dock seriously with something like that, I would recommend something a little bit more robust like Ninja or TradeStation or MultiCharts. Beyond that, if you don't want to go the automation side, if you don't want to go programming a strategy, totally fine. Just make sure you always track your data. Okay. So data doesn't lie. You might think that you're doing okay. You might think that you're doing great, or maybe you realize that you're not doing so well, but you're not really going to know what areas you need to improve on unless you're tracking it. So there's tons of great journaling softwares out there now as well. One of them is TradeZella, gives you a lot of insight and more dimensions into your trading so you can really see what you need to improve upon. So always continue tracking your data. Backtesting is great, but being able to get an accurate forward test and actually monitor how your trading is in real time through a journaling software is invaluable and something that will actually teach you a lot about yourself and tell you where you need to improve. Okay, so those are a couple good lessons right there. However, we got a lot more. So the next one is win rate. So win rate means absolutely nothing. Now that's something I wish I learned a lot sooner as well. And I got to say, it's something that I've always heard, right? Risk reward matters more than win rate. I truly believe that. And a lot of newer traders and even just newer investors that are thinking about getting into active trading have a huge misconception that you need to win more than you lose in order to make money. Now, that is true depending on how you look at it. You need to win more money when you're right versus how much you lose when you're wrong, but you don't need to win more times than you lose. Okay, so what I mean by that is how much you win is much more important than how often you win. Okay, and the reason why that's important and the reason that that even makes sense is all from risk to reward ratios and skewness. Okay, so if you lose $1 to make 5, then a low win rate strategy will survive. But if you risk $1 to make $1, you need a much higher win rate to turn a profit. And even worse, if you are risking $2 to make $1, you definitely need a higher win rate to survive. Now, when you flip that equation and you risk less to make significantly more, you don't need to be right as often in order to turn a profit. And that is something that is incredibly important. Now, I will tell you some of the best trading systems that I've seen that have ran, millions and millions and millions. I'm talking 30+ millions of dollars of live capital on the AlgoExchange platform are literally 30% win rate strategies. And not just one, but multiple strategies are very, very, very much in that boat. Okay. So I've seen this in the real world, with multiple live years of track record underneath those strategies' belts. They're 30% win rate strategies. And the reason they're able to turn a profit is because they are right massively when they're right, and they are wrong small when they are wrong. And it is just one of those things. that systematically it's a lot easier to do than when you're doing it manually. And the reason for that is because it feels good to be right? Our brains want us to be right. Now, when you are trading and you're taking a bunch of small losses, it's very easy to get in your head and think this strategy doesn't work. I can't take this much longer. If I keep going down this path, I'm going to be at zero in no time. And that just is not the right way to look at it. Okay. Just when you take a losing trade, that doesn't mean you're a failure. It is simply just a data point. So that is one of the things where you really need to understand that, but you also need to understand what the strategy looks like on a large data window, which is why we talked about backtesting earlier and why you need to expose an idea to a very large data set before trading it live. Okay, that is going to be one of the things that I'd highly recommend. And even all these people out there that are selling courses and teaching strategies, you can actually take what they're teaching you in those courses, turn them into a code, into a program, throw it in NinjaTrader, throw it in TradeStation, and see if it actually performs. Because that's the reality, is that a lot of these strategies might not in the long run, and it's very important that you know that. So I would definitely recommend, just to go back on the previous lesson, is that you expose any strategy to a large data set, and that data set is going to be your confidence to be able to stick through those strings of small losses. Okay, and that's how those two lessons tie together, is that when you have the data that's telling you that a strategy works, it's a lot easier to get through those rough patches when you are taking a lot of those smaller losses. Okay, so you want to have positive skewness in your strategies, which is where you have smaller losers and very large winners, but most traders unknowingly are trading negative skew, which is where you have a lot of small winners and then occasional large losers. You might think you're on a roll, and then you get into a rough patch and you lose months and months of progress, in a very short window of time, and that is very destabilizing, and it's just a nightmare to deal with, right? So get rid of the negative skew trading behavior, go towards the positive skew. Those are great lessons and stuff that I definitely wish that I learned a lot earlier, but it's one of those things that when you have the supplemental information and the data to know that the strategy operates that way intentionally and leads to a profitable outcome, it's a lot easier to stick to it. And I made an entire video on skewness that I would highly recommend you check out. Now, another lesson is stop capping your winners. Okay, so when you have a winning trade in progress, let it continue to win. Most people have these fixed risk to reward ratio targets, and they often leave massive alpha on the table. And the reality is you simply just cannot afford to do that. So if a trade is working, let it run and actually add to it. Okay, I want you to think about it this way. If you're selling a product and people are buying your product, are you going to stop selling them the product?
You just say, no, I'm good. I'm good for today. Store's closed. No.
If the business is still open and you got inventory and buyers are lining up out the door, you're going to keep serving them. Okay. And that is the same thing that the market is doing whenever it's agreeing with your trade idea. Keep the trade going. Add fuel to the fire, let the win keep getting bigger, and that is honestly going to be a massive game changer. So add to your winners, but cut your losers fast, right? Losses are data points. They're not failures, but your winning trades, the ones that really, really run, can make up for a couple weeks of losses at times. Sometimes a massive, massive winner could be a big part of your yearly P&L. And I know that might not sound great or logical, but that's the reality. If you go through and trade a couple different setups over the span of a year, maybe you have, a couple weeks or maybe even just a couple days out of that year that gave you a massive, massive chunk of your P&L. And that's going to be one of those things to where you're never going to get to that point if you keep having these fixed 1 to 2 or 1 to 3 targets, because you're basically chopping off your runner's legs. So if you have trades that are running, let them run. Don't cut their legs off. Let them keep going. Let them keep making you money. And if there are customers lining up out the door and the store's open for business, keep it going, right? So that's the analogy to think of. When you do that, the game is going to change for you. And that's how you're going to start to get these massive, massive winning days. You start adding to these positions. And the key there is that you manage your risk accordingly, so you're not taking on too much additional risk just because you add to your position. Okay. Now, adding to positions is one of those things that can be a little bit subjective. So you need to have a system for how you add to your position. That's another topic for another time, but adding to your positions and letting your winners run is absolutely important. And it's equally as important as cutting your losers fast when they're wrong and just stacking them up as data points, not actual failures. Okay. So next lesson is knowing your setup and your market. Okay. So again, we're going it back to the previous lesson of getting data on your strategy, but you really need to know your setup and you need to understand the market that it thrives in, right? So if you're going to be trading a trend following strategy, trend following momentum strategy, then you want to be doing that in a market that is a trending market. Okay, so like a trending market, for example, would be something like the NASDAQ or even the S&P. Now the S&P mean reverts a little bit more than the NASDAQ, but in those types of markets, these are equity indices, stock indices. These are going to be markets that when they start trending, they rip. So trend following strategies do really, really well in those types of markets. Now, mean reversion is super popular in small cap equities. Now, small cap equity strategies might not work in NASDAQ futures. So it's really important that you understand the market that you're trading and the setup that you're trading and making sure that there's alignment between them. Because you want to make sure that obviously the risk that you're taking is justified. And again, all this goes back to knowing the data behind the setup that you're trading. So understand, the setup in the market and make sure that there's synergy there, because strategies are not interchangeable across asset classes all the time. There are some cases where they are, there's some cases where they aren't. And you really just need to know, what it is that you're doing and why you're doing it, and making sure that the market that you're trading is conducive for that trading style. Okay, so next lesson is some strategies work great in one direction over the other. So maybe you have a strategy that crushes it long only, but it doesn't do well on the short side. And that's totally okay. It's all about understanding where the efficacy and where the edge of a particular strategy lies, amplifying it, maximizing on it, and then having another setup in your playbook that complements its weaknesses. Okay, so build a playbook. Don't just discard a strategy because it only works on one side. There's nothing wrong with having a couple good long only strategies and then having some short only strategies and maybe some long short strategies in between. This is one of those things where you really just need to have different pieces of your puzzle to be able to paint the whole picture. Okay, and that's why I want you to think of each strategy in your playbook. It's like a puzzle piece. They have merit on their own, but when you piece them together, that's when the full picture becomes clear. Okay, so build a playbook. So next lesson is that drawdowns are normal. Sometimes people think that if you go through a drawdown or if a strategy has a rough patch, maybe it's a rough month, that they need to pivot and go do something else. And that isn't the case. Every single strategy is going to incur a period of drawdown. It is absolutely a totally normal thing. And there's no reason that you should jump ship because a strategy is just going through a rough patch. It is normal. And this is where diversification and having those multiple setups in your playbook comes into play, and it allows you to hedge the strategy that's performing poorly with that is doing well. Okay, so a drawdown does not mean that a strategy is broken. It simply just means that the market condition is not favorable for that particular strategy, and that is okay. This is why diversification matters so much, because one strategy's drawdown should be offset by the performance of another one in your playbook. So don't jump ship, just have a plan, trust the data, and stay in the game. So those are a bunch of lessons that I learned, guys. Nowadays, everything I do is completely algorithmic and systematic. We actually have a platform called AlgoExchange where we run over $70 million of live capital for retail investors, retail traders. So if you're interested in accessing some of the systems that we're running, check the links down in the description, see if it's a good fit for you. And if so, be happy to share some more information on that. But regardless, I hope these lessons gave you guys some value. It took me years and tons of risk to learn everything that I just shared with you in this video. So I hope you guys took some notes. Hope you guys got some value out of it, and I will see you in the next one.